Guys, big earnings this week, like we talked about. We're going to go over UPS, Coca-Cola, and GM and do a stock analyzer on Coke. But before we get there, Mo, there are a few other companies you might want to report about.
Yeah, so a big one is CLF. A lot of people like this one, the iron ore industry. It's been raging here and there. Ray Dalio was in it. They missed earnings per share right here. 29 cents versus 59 cents expected. Revenue came in at 5.7 billion versus 5.82. They are down 12% pre-market. 3M. This is a big stock. I mean, it's an 8-pillar stock, if I'm not mistaken. A lot of our community likes it. Beat on earnings per share, $2.69 versus $2.62. Revenue, however, was low. That's something I'm consistently seeing is revenue is missing on a lot of these companies. They're not down very much. They're down less than 1%, but
not quite an 8-pillar stock. Okay. Net income's down.
Close.
That's okay.
Yeah.
All right, first company, guys, GM. Let's talk about it. So GM reported $2.25 earnings per share versus $1.89. Revenue came in at $41.89 versus $41.77. And of course, they're a car company like Tesla, so they need to report on EV. And they just secured a 1 million battery unit commitment for 2025, and they expect to sell 400,000 EVs between now and the middle of next year or something along those lines. So guys, again, EV is awesome. EV is great. But Tesla isn't the only one that does EV, and GM and all the car companies are getting big into EV. So remember that going forward, when it comes to each individual company, when you look at EV, remember. Now, one thing I want to show you about GM.
GM's new EV truck is awesome.
Is it?
Yeah.
What is it? Why don't you pull it up?
GM's. Let me pull it up. It's pretty cool.
So one thing I want to make note here. Look at the price to sales ratio on GM. So let me get our marker going. So the price to sales ratio on GM is 0.4. So what does that mean? It means the market cap, if you take the revenue of the company, 132 billion, multiplied by 0.4, you get your market cap here. Now, this is what I talk about when it comes to these companies, because look at Tesla. Tesla is 10.1 right now. Now, of course, a lot of people are going to say Tesla's not a car company, and I'm working on a breakdown right now of its revenue. In the last 4 or 5 years, its majority by far is car sales. So it's a car company. GM has its issues. I'm not trying to get into anything about unions, but when it comes to U.S. companies, I think it's hard to compete with such a high union cost. I think that's going to be a hindrance for these companies going forward. Let's look at their pillars. It's not the prettiest. Very low return on invested capital because of negative free cash flow. So right now, I'm immediately thinking to myself, I don't really want this. When I see negative cash flow the last 5 years, why do I want that? I just don't get it. So I'm going to go to the cash flow statement and see why that's been that way. Yeah, it's negative free cash flow every year. Pass.
Yeah, forget it.
Yeah, I just look at it going, listen, it's nice to look at a company, but if somebody proposed a company to me where they said, hey, look at our earnings, but guess what? We have negative free cash flow. I'd be like, all right, then how am I getting paid back? Mm-hmm. So I'm just immediately dropping. And look at do they have a dividend? Yeah, dividend yield of 1.1%. Sorry, and look at this enterprise value, a lot of debt. $221 billion enterprise value versus a $53 billion market cap. This shows that the difference here is debt that you're acquiring, basically taking advantage of that. You know what I mean?
So when you look at a dividend, it's not very much, but they don't have free cash flow. So
they have to take on debt or issue shares. That's the only way to pay a dividend is, well, unless you have the cash on hand. But Again, you're depleting that cash. You have to sit there and replace it with something else at some point.
Here's a new truck. It's pretty awesome looking. Here's the big thing for me, 400 miles per charge. I mean, that Ford Lightning is only 300 miles per charge, and it gets less than 100 miles per charge when you're towing.
What?
Could you imagine? I mean, some guy did a video on YouTube, and he got like 80 miles per charge towing.
How do you even tow?
I don't know. This is the interior. It's pretty cool. Big screen.
Trucks are back, baby.
Yeah. They're cool.
All right, next company, UPS, reported $2.99 in profit versus $2.84 per share. Reported $24.2 billion in revenue versus the expectations of $24.3. So they missed slightly on revenue. Mo, can you please talk to me about UPS? Because I know shipping companies in general own your brain, and I want to see what your opinion is on this.
They do. So here, the thing that I actually wanted to see a lot from UPS was what was their forward guidance going to be, and they reaffirmed their outlook because FedEx slashed theirs so much. They maintained that their operating margins are going to be 13.7%. Full year revenue stayed the same. Their overseas shipping and that heavy pallet shipping it fell 6%, but it's not terribly surprising.
Well, yeah, I mean, shipping was a very big revenue generator for I mean, our shipping cost for a container from China went from $5,000 a unit to 20 to 25,000 a unit because of all the supply chain issues. I mean, it was insane. So I imagine all these companies were able to really increase their revenue on international shipping, right? Mm-hmm. Now, guys, remember, we care about guidance to a certain element. When I'm as a value investor, my goal is to buy a company regardless of what's going on a year-to-year basis. I want to look overall with the company, make long-term projections, and see, hey, can I buy the company today at a price that makes sense today, no matter what happens in the future, high or low? They're going to miss sometimes, they're going to hit sometimes, they're going to beat. It doesn't matter. We're looking at long-term investments. So even though it's nice to feel warm and fuzzy inside, don't make your assumptions on the profit of UPS based on, look at the revenue, guys. Look at the last 10 years, 55, 56, 58, 59, 64, 69, 72, 77, 92, 100. Big jumps here in the last few years. Very large jumps. Why? Because of supply chain issues, they could charge a premium. Let's look at the profit numbers. I mean, they were in the low to mid single digits for a long time and then skyrocketed. So my opinion is you can't buy the company based on last year's superior huge numbers, right? Sure. Now, Mo, what were they guiding for next year? What was the actual guidance for revenue?
Okay. Yeah, so guidance full year 102 billion for next year.
Okay, so a little bit of growth.
Yep, a little bit of growth, and then the margin is staying consistent, and that's important. I can't remember the exact number that FedEx cut theirs, but they slashed theirs, and that was their. Remember they had a 20% down day or
yeah, it was a big. Okay, amazing. So UPS is still sitting there saying, "Hey, we might be stable here." Yeah. Okay, great, I like that. But the question is it really a permanent increase in cost? Now, great news is with inflation, revenue here will go up. It's just being passed on to customers, of course, and the profit should stay the same. So 8 pillars here.
I don't like this dividend.
Oh, what's the dividend? Oh, 3.7%.
Yeah, 4.29 billion. 5 year. Yeah. And I just went back to their cash flow statement and looked. So if they're paying, go back to 2013 and just come through here. 4.29 is a lot, with the exception of, even that's still almost 40%.
And you know what else, Mo? Look at their 5-year PE and their 5-year price of free cash flow.
Discrepancy?
Very well. No, that doesn't bother me as much, but it's very, very high. Yeah. For a low growth company like this, it's very high. So if it starts to fall, that dividend yield is going to go higher. And when it eats up so much of their free cash flow, what are they going to do? They're going to have to cut it. Yeah. They're going to have to cut it, guys. It's only free cash flow can only be used to do one of 5 things. And dividends, paying dividends is one of them. Mm-hmm. But you can't, we'd like to find companies where the dividend yield is less than 50% of the 5-year average free cash flow, right? Yeah. All right. Final company, Coca-Cola. Guys, Coca-Cola only exists because I drink 6 to 8 Coke Zeros a day. Before you judge me on this one, I've looked into the research. I can have 48 Diet Cokes or Coke Zeros a day before I get to the level of aspartame that becomes above the FDA-approved level, suggested level. That's pretty good. So suck it there. I love Coke Zero. I literally drink 6 to 8 a day. This is not an exaggeration. I love it so much. I have it in my veins. It is so wonderful. Literally, my fiance says to me, "You judge every restaurant based on how their pop is." I'm like, yeah. And when I find a restaurant that has Coke Zero, first off, out of a can, I'm ecstatic. And second, out of the fountain, I'm even more ecstatic. Now, I want to tell my story.
Okay.
What's the restaurant in Chicago that's owned by
RPM?
RPM? Thank you, RPM. So years ago, I went to RPM in Chicago. And I went there with 2 friends of mine, a couple. We sat down and said, "Hey, do you have Coke Zero by chance?" The guy says, "You know what? I don't have Coke Zero." I'm like, "Great. I'll take a Diet Coke." My 2 friends ordered their fancy schmancy drinks. So 5 minutes passes. He comes by with the fancy drinks. He goes, "I'm still waiting on your Diet Coke." And I was like, man, what is going on here? I'm like, it's a Diet Coke. How hard is it? But I'm fine with it. Whatever. No big deal. So we go talking, and all of a sudden, the waiter comes to the table with 2 bottles of Coke Zero. And he said, "I had one of the guys run out to the CVS down the street and bring me Coke Zeros for you." Needless to say, the guy got a monster tip. He got a 50% tip on that because I thought to myself, amazing. So I'm going to plug RPM here. I have no affiliation with them.
RPM is great.
Is it really that good? Yeah. I've only been there a couple of times, and I'm not a foodie, so I don't really know.
I like it a lot.
But either way, RPM Chicago, thank you very much for that, because I love the guy for him doing that. And at first I was like, oh, I didn't care when the Diet Coke didn't come. I was like, I would have thought that'd come out. Anyhow, back to Coca-Cola. They reported 69 cents versus 64 cents, and they reported 11.1 billion in revenue versus estimate of 10.5. So they really crushed it. They did a great job. Let's look at their actual report here. So let's look at this. Global unit case volume, 4% growth. Revenues, 10% growth. Organic revenues grew 16%. Yeah, so operating margin was 27.9 versus 28.9, so a little bit of a drop. EPS grew 14% to 65 cents. Let's see, the Coca-Cola company today reported everything. So, guys, everything seems to be in line. They reaffirmed on next year. They're saying they grew market share in total non-alcoholic ready-to-drink beverages. Cash flow from operations was $8.1 billion. Now, remember, that's not free cash flow. It's cash from operations. And free cash flow is cash from operations less your capital expenditures. But it was down quite a bit, $1.2 billion versus the previous year. Okay, so let's see. Let's see what else is going on here. Nothing else that's really like makes me go, the currency impact's a big deal because the US dollar is very strong. So it's been a major focus on a lot of companies that do international work. I like to just steady those out and just not look at that as a main driver for revenue or profit. I don't get excited if I see it help. I don't get bummed if I see it hurt. So that's where I stand there. So let's look at let's look at Coke Zero. Oh, sorry, Coke. They should just rename the company Coke Zero, Tim. What do you think? Dig it.
Tim likes it.
It's up barely, 0.5%. Not a big deal. Forward dividend yield of 3.2%, pays out 7.5. Now that eats up a lot.
And I did the same thing again. I went back to 2013 and ran it through, and that's a lot of money coming out of that free cash flow. 7.886. And I mean,
but for a company like Coke, which is very mature, I don't like it. Right. And as the stock falls, I mean, what was the dividend yield again? 3.2.
Yeah, 3.2.
I mean, they're gonna. I mean, Coke's one of those. Isn't that one of the dividend aristocrat companies? Probably. I have to look that up.
Probably.
But guys,
like Johnson & Johnson.
I just don't see, like, if the stock falls 30 or 40%, you might sit there and say that's not going to fall 30 or 40, whatever. The point is, I mean, by the way, look at the stock. Let's see the stock over the last. I mean, look at this. In 1999, it hit $43 a share. It's currently at $58 a share. So in 23 years, it's only up. What is that? Not even 40%. Now, you got your dividends along the way, which helped. I get that. But it's like, okay, it's not a huge return. So they're trying to, we'll see what happens here. Let's look at the 8 pillars.
They went to a low of $37 during COVID.
Below the 1999 high. Yep. Well below. Okay, yeah. So high PE, high price of free cash flow, small issuance of shares, not a big deal. A little bit higher debt. I'm not going to worry about the debt with Coke. That Coke brand is worth an obscene amount of money.
Right.
I'm not worried about that at all. Increased revenue, increased net income. You might sit there and go, how is net income higher than revenue? They might have had a off year 5 years ago. We can look at that right here. Look at the income statement 5 years ago. Yeah, it was kind of a fluke down year. 2.38 versus 4.15. And the next year they did 7 billion. So it looks like it was just a fluke year. But this is what we talk about when we talk about our 8 pillars. It tells a story. And that story here is telling me what's going on here. Okay. So let's do analyst estimates here. All right, so not much growth, low to mid single digits.
Actually more than I thought it would be.
Really?
Yeah.
Actually lower than I thought it would be, because if they're growing, 5, 6, 7% revenue, and gross margins, what in the company? Gross margin is 59%. I would have thought it would have a much higher drive to the EPS. You know what I mean? 9%, I mean, that high gross margin, when you're able to increase revenue, even if it's only a few percentage points a year, high gross margin will really throw a lot of money to your bottom line, especially if you keep your fixed costs very steady.
So I want to see what you put in Stock Analyzer then.
Okay. So Stock Analyzer, I'm going to go with 0, 2, and not 4%. 0, 1.5, and 3% revenue growth. Okay. The thing is with inflation though, inflation's a really, I don't know. It's kind of hard. All right. Profit margin. Fluke profit margin last year, it looks like. So I'm going to do 17, 18 and a half, and 20%.
Okay.
Free cash flow, I'm going to do 18, 19 and a half, and 21. PE, 14, 15, and 16. I'm sorry. I know it's Coke, and it's got a great brand. but I look at the multiple and think,
Where's the growth?
where's the growth? And I still don't want to pay. Well, what's the return on invested capital, Mo? Can you pull that up real quick?
Yeah. Return on invested 14.2
I mean, that's a high return on
good.
invested capital.
for a pretty capital intensive business.
Is it capital intensive?
I mean, that's all cans.
Well, look at the cash flow statement.
Okay.
What percentage of their look at their. No, it's not a capital. It's not high capital intensity. It's about 10% of their cash from operations is spent on capital expenditures.
Okay.
So what I did there,
That's
guys,
surprising.
was when I look at capital intensity, I want to see what percentage of their revenue or cash from operations are they spending on capital expenditures. Because capital expenditures, businesses that are very capital intensive, need to be reinvesting back into their business at all times. This isn't so bad, in my opinion. Hit the analyze button. We're $58 a share. Oh boy.
Oh no.
A low of high teens, a high of low 20s, mid price of 20. I mean, go alter your numbers any way you want. If I go up here and alter this to 2, 3, and 4, profit 18, 19 and a half, 21, and then PE of 15, 16, 17, you'll still see. I mean, it's still overpriced by a lot. Low 20s and mid 20s.
Wow.
So guys, this is our video. Please subscribe because we have a lot of these videos coming out every single day, especially in the next 2 weeks with earnings results. Thank you very much for your time.